Index funds are a popular way to invest in the stock market by tracking a specific group of companies all at once. The main goal of an index fund is to provide instant diversification, which helps spread your risk across many different assets. Instead of buying one stock, an index fund lets you buy a basket containing hundreds of companies in a single transaction. Investors often choose these funds because they are simple, cost-effective, and provide exposure to a wide slice of the economy. The big difference is management. Index funds follow a set list of stocks, while active funds pay managers to try and beat the market. Because index funds require less research and trading, they typically charge much lower annual fees compared to actively managed portfolios. This famous quote captures the philosophy behind index investing, which focuses on owning the market rather than trying to outsmart it. Remember to research the specific index a fund tracks before you invest. This has been an educational overview, not financial advice.